Have you ever wondered where money actually comes from? I mean, not just the paper bills and metal coins, but the vast majority of money that exists only as numbers on a screen. You might think it's all printed by the government, but that's only a tiny part of the story. The truth is, most of the money in our economy is created by commercial banks, just like the one you probably use every day. And they do it every time they make a loan. Sounds crazy, right? Let's break it down. Imagine you want to buy a house for $300,000. You go to a bank and apply for a mortgage. If the bank approves your loan, they don't just take $300,000 from someone else's savings account and give it to you. Instead, they simply type a few numbers into a computer. They credit the seller's account with $300,000 and simultaneously, they create a new asset on their own books, your loan, which is your promise to pay them back with interest. In that instant, $300,000 of brand new money was created and added to the money supply. So the money you deposited in your account? It wasn't transferred from somewhere else. It was newly created. And now the seller of the house has that $300,000 which they can spend, save, or invest. That new money circulates through the economy, buying goods, paying salaries, and funding businesses. New money is created. But wait, if banks can just create money, what stops them from creating an infinite amount and causing hyperinflation? Well, there are a few important checks and balances. The first is called the reserve requirement. Central banks, like the Federal Reserve in the United States, used to require commercial banks to hold a certain percentage of their deposits as reserves, actual cash in their vault or on deposit with the central bank. However, in recent years, many countries, including the US, have reduced the reserve requirement to zero. So, what's the new limit? Today, the primary constraints are capital requirements and profitability. If too many loans go bad, the bank's capital gets wiped out and it can fail. This forces banks to be careful about who they lend to. Profitability is the other major factor. Banks are businesses. If the economy is weak and they can't find creditworthy borrowers, they won't lend and money creation slows down. The second major check is interest rates, which are controlled by the central bank. When the central bank wants to slow down the economy and control inflation, it raises interest rates. This makes borrowing more expensive for both commercial banks and for you and me. If mortgage rates jump from 3% to 7%, fewer people will want to take out loans to buy houses. Businesses will also borrow less to expand. This makes borrowing cheaper, encouraging more people and businesses to take out loans. This is the main tool central banks use to manage the economy. So, what happens when you pay back your loan? The process goes into reverse. Each monthly payment you make on your $300,000 mortgage has two parts, interest and principal. The interest part is the bank's profit. The principal part, however, is what pays down the loan. When you pay back the principal, that money is effectively destroyed. It vanishes from the money supply in the same way it was created. Think of it like this. The bank created a $300,000 asset, your loan, and a $300,000 liability, the deposit in the seller's account. As you pay back the loan, the asset shrinks. Once you've paid it all off, the loan asset is gone from the bank's books, and the $300,000 of new money it represented has been removed from the economy. So, money is constantly being created when loans are made and destroyed when loans are repaid. The total money supply grows only if new loans are being created faster than old ones are being paid off. This system is known as the fractional reserve banking system, although the name is a bit of a historical holdover now that reserve requirements are often zero. A better name might be the credit creation theory of banking. It's a dynamic system where the amount of money in the economy is not fixed but expands and contracts based on the demand for loans and the willingness of banks to lend. It's a powerful and frankly mind-bending concept. The fact that private institutions can create what we use as money simply by making a loan is one of the most important yet least understood aspects of our economy. Thank you so much for watching. If you found this explanation helpful and it made you see money in a new light, please hit that like button and subscribe for more deep dives into how our world really works. Let me know your thoughts in the comments below. Did you know this is how money was made? See you in the next video.